If you're just listening, of course, you're tuning into the Real Estate Talk Show, and we have with us a fantastic gentleman that knows all there is to know regarding mortgages. And this is stuff that people need to understand because they're not handling their wealth properly. So we have Michael Sistilli here, and he, of course, is the Client Service and Mortgage Investment Manager with Real Wealth Group. Say that 10 times. Wow. But this is a valid point. We're giving these case studies to explain to people that it's wonderful to own a home. Fantastic. I mean, this is what we're trying to tell people. Buying land, buying property, it's a great investment. But it's also how you handle that investment that takes you to the next level. Mm-hmm. And a lot of people are sitting on these properties, Simon, and they just kind of think, okay, I'll just keep paying it off, but they don't know what to do next.
Well, look, as Canadians, I've said it before, and at the risk of insulting some, and maybe not most, Canadians are conservative, chicken, and cheap.
Yeah, you do say that a lot.
I do say that a lot, but it's true. It's so true. But here's the thing, okay? Here's the thing. I look at a house like a ridiculously fantastic bank account. And you've got equity in that bank account. That is your house, whether it's an income property or the house you live in. You've got to manage it effectively. You've got to minimize taxes as much as possible legally. So I'm all for minimizing taxes, but I'm also looking at, instead of just leaving the money sitting in your home and making 4 or 5% as the market increases, how do we leverage that and make 8, 10, 15? And there's even opportunities out there to make 25 and 30% per year when you start getting into income properties and so on. But, correct me if I'm wrong, Michael. You explain this to people and they still say, what's the catch, right? Or they're still
absolutely
confused about it or nervous about it. Yeah. What could go wrong? Absolutely. I'm going to lose my house. So what do you say to people when they say that?
I say that it's understandable to be nervous at first, especially with something that you're not used to, but you need to look at the bigger picture. You need to understand that everybody wants to get into the real estate game. Everybody wants to, how can I build my wealth? The best way to build...
Without losing it.
Without losing it.
Rule number one, right?
The best way to build your wealth is to access wealth you've already created. And that's through the equity of your own home. Using the equity of your own home, especially with a home equity line of credit, it allows you to invest, make a return, but then because of that interest that you've earned on that investment, you can actually bring down your taxable income, which will help you at tax time, help you build wealth through property, through mortgage investments, etc.
Okay. Now, Michael...
I want to add one more thing before we go on, and that is this. Just to alleviate the concerns about risk, here's what people fail to understand. When you're taking your money out of your equity line to invest in something else, isn't it always secured against another property, Michael?
Yes.
Isn't that the case? Yes. So for those that are concerned about risk, another way to look at it is instead of having your money secured against one property, which is yours, you can actually diversify and have it secured against two properties, which actually is less risk than having it just in
on the
one
property itself.
And you can use that, and we'll just charge you a small fee to use that.
Oh, and he will. How about home equity line of credits? Are they easier or are they harder to get approved for?
In actual fact, they are harder to be approved for, and the reason for that is the qualifying rate is higher. It's the Bank of Canada qualifying rate of 4.79%. And the reason they use a higher qualifying rate is so that they can make sure that you can afford this. You can afford
what
this
if rates
product.
go up? Absolutely.
What if rates go up? Yeah. And they don't want to, as we said at the beginning, they don't want to put themselves in jeopardy, but also they don't want to see their client come back to them in a few years and be like, what am I doing?
It's an excellent point. And I'll tell you why. Because when people look at the Canadian market and the Canadian real estate and financial markets and say, why is it that Canada didn't experience the same meltdown that the U.S. did? It's because our banking system is so conservative. So it's actually a very, very good thing. So people talk about affordability, they talk about risk. Our structure is so conservative that it's actually worked in our favor. And if anything, it's a good thing.
It's a great thing because globally people are trying to, other institutions around the world are trying to mimic it, right? Mm-hmm. All right, how about this? Pros and cons with home equity lines of credit. You got to have some for me here. Why don't we start with the cons? Let's go negative first and finish with positives.
The home equity lines of credit, when you actually do look at them, they are the highest interest rate of all the mortgage products out there, fixed and variable. It is 3.5%. Also, if you do not manage it properly and you do only pay interest only because of the cheap amount, you will not bring down your principal whatsoever. And that's where it could get dangerous.
Okay.
So you just have to manage it effectively. But I have a quick question. In order for it to be tax deductible, does it have to be a separate, like if I have a first mortgage for $100 and a HELOC, home equity line of credit for $100, and I invest that second 100, does it have to be that structure for me to get the tax deduction? Or could I simply refinance my house for a new first mortgage of $200,000 at the lower rate, obviously? And we're talking about saving almost an eighth of a point or something. Does it have to be separate, or can it be in one lump sum and then just deduct a portion?
It doesn't have to be separate. It's easier if it is separate, because one thing that the CRA wants to see is that you can show and support what you have done the investment in.
They want proof of everything, yeah.
They want proof of everything, yes. It's actually called direct tracing. Now, you can do what you said, have a fixed mortgage, which gives you some money, some freedom. However, you would have to substantiate how much of that is principal, how much is interest. It would get very complicated for the client, and if it's not explained properly, the client would probably get discouraged very easily.
Right. So for the difference and because it's tax deductible, for the difference in, let's say, half a percentage point, it's probably not even worth worrying about. Just get a separate HELOC. The accountant knows what to do with it. CRA knows what to do with it. Everybody wins, and you write it off. Love it.
Yeah, me too. Love that too. All right, let's finish with the pros. Give me some.
As I said, it is interest-only payments, which, again, if managed properly, they will be a lower monthly payment, which will be easily manageable. And also, it's unlimited prepayment. It's open. You can pay it at any time.
No penalties.
There's no penalties whatsoever. So if you do have extra money and you do have the ability to pay further, you can feel free to just bring down the principal amount. And then once your investment is done, it's extra money in your pocket.
Love that.
Except that that's a tax deductible expense, so you may not want to pay that down. But that's a different conversation. That's another show.
That's
another segment. We'll have you back to talk about that one.
That is a different conversation.
Michael Sistilli, you certainly know your stuff, and we do have to have you back. But of course, we have to remind our listeners, Simon, if people want to know more information, they want to get a hold of you, Michael, or anybody, of course, at Real Wealth Group, you can certainly go to our website, realestatetalkshow.ca, or call our help desk anytime, 416-366-9090. And of course, we have links directly to Real Wealth Group, and they love getting all your questions, and certainly you get right back to everybody, which is fantastic.
Absolutely.
So job well done again.
Thank you very much.
Great job, buddy. I'm sure Mama and Nonna will be proud.
Thank you very much for having me.
We'll have you back. We'll talk again.